Good afternoon, everyone, and welcome to Stock Market Today. It's Allie Coram and Ed Carson here with a breakdown of the action in today's session, where we saw horrendous action across the board, Ed, triggering a pretty bearish signal, which we will get into.
Yeah, this was about as bad of a day as you could have, especially after a follow-through day. But we're going to take a look at Target, which really triggered all this selling. Also going to take a look at Northrop, which held up reasonably well. And then Broadcom, which looked strong yesterday, not so much today.
Yes, we'll get to those. But first, let's take a look at those major indexes. So the NASDAQ down 4.7% by the end of the day. So heavy losses here. We also had the S&P 500 down 4%, the Russell 2000 down 3.8%, and the Dow down 3.6%. And as you mentioned, Ed, we did get a follow-through day signal in the market in Tuesday's session, but where we closed today raises the risks by a lot of that signal failing.
Yeah, I mean, we weren't super excited yesterday because, yeah, it was a follow-through day. That's a confirmed rally. Good sign that maybe things are going to keep going well. But it was below the 21-day, quite a bit, well below other moving averages. There was reason to have concerns about that follow-through day. But when you close below the low of the follow-through day, and we didn't, that was way beyond that. Wasn't even close.
Yeah.
On all the major indexes.
We closed well
below. But even if you close just a little bit below it, Eric Kroll, who's co-author of the Life Cycle Trade, growth investor, he's been on IBD Live a number of times. He's got research that if it does that happen, there's a 90% chance that the rally will ultimately fail. Now, the rally doesn't fail until you go underneath the low of the rally, which in this case was the May 12th lows. But it's a sign that things are really weak. I mean, things are supposed to be going well. It's like if you get a new car and it immediately breaks down and goes in the shop. That's not what's supposed to happen. I mean, it's supposed to keep trucking on down the road. It was anything but that.
Mm-hmm. So this raises the risk that it seems like at best we could see just small gains and losses from here, just kind of a slog through. But we'll see how it turns out. Instead of using our crystal ball, we lean on data and real-time analysis, looking at history to be our guide, but always being flexible when new information presents itself, which is why, even though a follow-through day is a signal to start dipping your toe back in the water, we say you have to have a measured approach. It's dipping your toe in the water. It's not plunging headfirst. And one of the other reasons, in addition to the technical levels that you pointed out, Ed, about where the NASDAQ is for, some sort of apprehensions about this follow-through day, is the fact that we weren't seeing a lot of setups out there, just, a plethora of actionable stocks. Like, in spring of 2020, after the coronavirus crash, we started seeing stock breakout, strong relative strength lines. It doesn't feel like we're in that kind of buying environment. So that was another sort of caution to yesterday's follow-through day, but it's preferable to have that error of commission than omission. If yesterday did spark a fantastic move higher, we didn't want to miss out on that. So that's why putting a little bit of money to work, but still managing your risk, is the method to proceed with.
Yeah, and chances are you probably wanted to pull out, scale out definitely, and probably get out entirely from those positions, because they clearly were not working today. A very negative signal today.
Agreed, Ed. Okay, just quickly flying through, look at the other major indexes. So some key action here for the S&P 500, because not only did it close well below the low of the follow-through day, but it did also mark a closing low for the year.
Yeah, it's a 52-week closing low. So there's been no night that things have been worse for the S&P 500 than this one in the last 52 weeks. And also just the look on the weekly chart. Does this look like we have a rally? I mean, it looks like the continuation of a downtrend. I mean, we're on track for a solid weekly losses. So yeah, that's not good. We're not far from the lows, the ultimate lows. That would mean an official end to the rally. So not good.
And similarly, the Dow also a closing low here, getting close to its intraday low on the 12th as well. So just continuing to bleed here. And like you said, Ed, this weekly chart not looking great. And just look at the streak of weekly losses too. Just a lot of damage that has occurred.
Yeah. And if we do hit new lows in the last few days, it will just be a blip, because you can see, if you take a look at those weeklies, some of those weeks, there were intraday gains. You could see where we had popped up. And so it looked like things were going well. And then, well, but ultimately it didn't. So you look at daily charts, we look at intraday charts sometimes, but you want to take a step back and look at weekly. And this one does show a picture that we have not broken. It doesn't look like we've broken this correction yet, even though we are still in a rally.
That's right. And also taking a look at the Russell 2000 with the IWM ETF, also down for the week here. And we can take a look at the 10-year Treasury yield briefly before getting into the stocks we want to take a look at, down, but still at sky high levels. So pulling right back into this 21-day line. So still a bit of a pause from the sharp rate of ascent, but still not letting up much, and not any signs at this time that we're going to see them come off in a big way yet.
No, and this is more a reflection of the market being weak and concerns about the economy. So this isn't like a great sign that Treasury yields have come down. It's a reflection of weakness elsewhere.
So speaking of a weak economy, we need to take a look at Target, because as you mentioned, that sparked the widespread sell-off today and showed that the retail and consumer woes were not just limited to Walmart. So Target here plunging some 25% today, a huge hit to that bottom line number. Another quarter of slowdown in sales growth as well. So signaling weak consumer and therefore a weak economy.
Yeah. So Target was warning about rising delivery costs. I think delivery to the store, I think logistical costs, and then weakness in consumer discretionary too, like TVs. And so that's tough when you've got rising costs and then weaker demand, especially on maybe your higher margin items. That comes after Walmart warning on all sorts of costs, and on labor, on supplies, the price of goods. And yeah, maybe yesterday you could think, well, maybe it was just Walmart, but now it's like this Target. It's like, oh boy, if these two retailers that should have, these are the ones that people should be going to in bad times, and they're so good at managing costs and all these things. If they're running into trouble, this is a bad sign for discounters, a bad sign for retailers. It's a bad sign for related industries, goods makers, shippers, heck, the whole economy. So, Dollar Tree. We looked at this yesterday, and it was holding up okay. It fell on Walmart, but okay. You could see it was still in that range. In fact, you could have argued, hey, a good day. We might have a buying opportunity today. Well, it is not. I think this is also a good example of why you look for stocks with strong relative strength in a bad market, but then you wait for that buy signal. Even though we say, hey, these are the stocks that might do well in a rally. Well, sometimes they hold up, and then they break. And so this one does not have a good looking RS line, right now. So, there was a lot of damage on a lot of sectors today. Obviously a huge sell-off across the board, but really damaging. And you can sort of look at it and go, wow, I don't know. That could be it's just a difficult course to navigate. There's not a lot of great scenarios for the economy, for profit margins, in the near future.
That's right. And just taking a look at the broader retail sector, here's the XRT ETF, down some 7% this week, 40% off of its 52-week high, but sharp decline today, no doubt. So continuing this big downtrend. Anything else in retail that we need to point to?
Not really. I guess we could just show JB Hunt,
Yeah.
To just sort of throw that. It's like, if there's weaker demand for goods, maybe they'll have trouble with less demand, and they'll be harder to ship fuel surcharges on to companies. I mean, this one sold off a few weeks ago. This was one of those markers saying, hey, this is getting bad. And it had this weak rally-ish sort of wedging higher in low volume. and then really sold off today. So a lot of bearishness in that, and it's not alone, but there's all sorts of weakness. The warnings that Target and Warren and Walmart gave send a really negative signal across a whole bunch of sectors.
That it did. All right. Well, one area that's holding up, or at least one stock, is Northrop Grumman working on a cup with handle. We also have a trend line drawn. You can see just starting from this peak here in early March, it's continued to tighten up. So volatility contracting here with Northrop Grumman finding support at those key moving averages. So this is one stock that is continuing to show relative strength in the face of widespread damage.
Yeah, I mean, unlike some of the other companies, I mean, Northrop has to worry about spending habits from other governments, and the U.S., apparently their defense budget is very friendly to Northrop. That's what some analysts are saying. Europe is going to be spending more, a lot of countries. So there's a backdrop for defense spending, obviously the Russia-Ukraine war. So this is holding up better. I mean, while the defense sector is doing very well, it's at 27, and that's with some losers like Boeing that are not in defense. So, I mean, if you just did defense, this is probably a top 10 group. So Boeing is really a weight on that, but Northrop is the only one of those major defense firms that's holding up above the 50-day line. I mean, doesn't mean it'll continue to hold, but there's a reason why to look. And so I don't want to, again, nice relative strength line, blue dot. You could argue that it's somewhat immunized from the economic woes, but definitely one to watch. But you'd have to be pretty brave to be, even if this does flash buy signals, it would be, you have to be pretty brave to be buying in this kind of environment.
Okay, well, we will keep it on our watch list, Ed. And also, let's take a look at Broadcom. The action yesterday seemed like, okay, we're going to start seeing some chip stocks perhaps come back in favor. We had a break of a downtrend for Broadcom, an RS line blue dot on the weekly chart, if not the daily here, with a move back above the 50-day line in above average volume, but keeping a tight stop on this one, which we did, turned out to be warranted.
Yeah, I mean, there was a lot of reasons to like it, and obviously if the market had continued to strengthen, this was likely to one to be doing well. It did not, and I if you bought it, you should have gotten out of that one because that was really negative action. This is still one to watch. The RS line hasn't fallen apart. This isn't breaking down below to new lows, but this is one, I think with the market environment, you just need to be watching this, and that's just you just have to be ready to be changing it. The market was saying one thing yesterday. Broadcom was saying something yesterday. It's saying something very different today.
Exactly. All right, Ed. Well, as we've been saying, even if you get a follow-through day signal that's not your automatic green light, that the skies are clear, it's time to go heavy in the market. It's time to dip your toe back in the water, but remain cautious. And we've talked about all of the headwinds that remain and could spell trouble for the market for an unforeseeable future, even if we do get short-term, oversold rallies here and there, which it's not in the cards today. Fear is out there, and heavy selling. But the point being, you have to remain flexible, even if you do get encouraging market signals, because you never know what the next session may bring.
I will say that the next session may not be too good for Broadcom. You can look at the after hours action down 3%, and I actually just checked the news. Well, what's happening is that Cisco, which is a networking firm, but Broadcom is sort of in somewhat networking communications as well. Cisco really guided low. So, it's not just that. So there's just a lot of weakness, and it could be more pressure on the market. We could end up hitting new lows very soon in this kind of pressure. Everything you said is right spot on. Have to be very careful in this environment.
And I think also be aware that we talk about staying nimble, and it's a really tough mental exercise, because just when you try to start switching gears to being more positive, then you have a day like today. It can be hard to convince yourself to change gears again, back the other way. But ultimately, that's how you're going to stay safe, is to preserve your mental capital above all, and your hard-earned dollars.
Yeah, absolutely. Got to preserve your capital, mental and physical.
All right, everyone. Thanks for tuning in. Ed is going to be hosting IBD Live in the morning, so the team has you covered for all the guidance you need in this crazy market. So make sure you tune in, investors.com/IBD Live for all the details. And the team will also see you at the market close for Stock Market Today. I'm off tomorrow and Friday, but I'll see you back next week. So have a great rest of the weekend, and I will see everyone on Monday. Thanks for tuning in.